Hello everyone!
And welcome back to another episode of the Financial Accounting Tutorials. Joining you today will be me, Alyssa Aboc,
And Bolyn, Garcia.
and we will be teaching you about
Notes Receivables.
Now, notes receivable are actually rather similar to accounts receivable, especially in the way that both of them are expecting to receive a certain sum of money or financial asset at a future date. However, notes receivable differ from accounts receivable because of two main reasons. First, notes receivables are actually formal promises, meaning they require to have a promissory note to be signed by the maker or the one paying, and this will be given to the payee, the one who is receiving. Now, this promissory note is a negotiable instrument, meaning the one who is receiving the sum of money or the one who is receiving the payment will be able to has the legal right to either sell or trade off this promissory note. The next difference is that notes receivable actually gain interest. Now, notes receivable are either interest-bearing or non-interest-bearing. When it comes to interest-bearing, it means that the interest is actually stated. However, when they say non-interest-bearing, it means that the interest has already been added to the face amount of the note receivable. Now, to further your knowledge on notes receivable, we will discuss to you about the classifications of notes receivable and the initial and the subsequent measurements.
So, there are four classifications of notes receivable. First is the short-term receivable, which is collectible within 1 year. The initial measurement for this kind of receivable is fair value plus transaction costs. Transaction costs are the costs which are directly attributable to the acquisition of the asset. The fair value is an amount at which an asset can be exchanged. For short-term receivables which are collectible within 1 year, the fair value is equal to the face value of the note, the present value when the transaction contains a significant financing component, and lastly, the transaction price when the trade receivables do not have a significant financing component. If it was initially recorded at present value, its subsequent measurement shall be its amortized cost. Lastly, if it was initially recorded at its transaction price, it is subsequently updated using the principles of IFRS 15, which is the revenue recognition. The second classification is long-term receivable bearing reasonable interest rate. Before we continue, let me first define what a long-term receivable is. Long-term receivables are notes receivables which matures more than a year. The initial measurement for this kind of receivable is fair value plus transaction cost, the fair value being the amount of the note. The subsequent measurement for this kind of receivable is the recoverable historical cost. The third classification is the long-term non-interest-bearing receivable. The initial measurement for this kind of receivable is the fair value, which is the present value of future cash flows coming from this receivable. Its subsequent measurement shall be its amortized cost. The last classification of notes receivable is the long-term receivables bearing an unreasonable interest rate. These are receivables which have a nominal interest rate that is lower than the market rate. However, if the problem is silent, it is better to assume that the nominal rate given is already reasonable. The initial measurement for this kind of receivable is fair value plus transaction cost, the fair value being the present value of future cash flows coming from this receivable. And finally, the subsequent measurement for this type of receivable is its amortized cost. So let us move on to our next topic, which is the present value and the future value of an asset.
This time, we will differentiate between future value and present value. When we say future value of an annuity, we refer to the amount at which a current investment will eventually grow to over time. But when we say present value of an annuity, we refer to the amount which must be invested today in order to guarantee ourselves a desired amount of money at a future date. When it comes to notes receivable, we are going to focus on the present value of an annuity. So here are three ways in solving for the present value. The first way to solve for the present value is the present value of 1, wherein the formula is the quantity of 1 plus I raised to negative n, or 1 over the quantity of 1 plus I raised to n, wherein I is the interest rate of the note receivable and n refers to the number of period. This formula is only used when you are paying the receivable in one big payment at the end of the maturity date. Next is the present value of ordinary annuity. The formula for it goes as 1 minus the quantity of 1 plus I raised to negative n all over I. This formula is used when there are several equal payments and each payment is made at the end of the period. Finally is the present value of annuity due, wherein the formula goes as 1 minus the quantity of 1 plus I raised to negative n minus 1 all over I plus 1. This formula is used when there are several equal payments and the first payment is made as a down payment, while the rest follows and is paid at the start of every period.
Now, we will be answering some problems on notes receivable. The first case is on short-term receivables. ABC Corporation received the following note receivables on January 1, 2016. A 9-month 10% note from Alpha Company worth 5,000, a 6-month non-interest-bearing note from Beta Incorporation worth 10,000, a 14% 3-year note from Charlie Corporation worth 20,000, and the market rate of interest on January 1, 2016 is 10%. The requirement is at what amount will the notes be initially recognized. All of the notes receivables will be recognized at their face amounts. Both the first two and the 9-month 10% note from Alpha Company worth 5,000 and the 6-month non-interest-bearing note from Beta Incorporation worth 10,000 are short-term receivables since their respective maturity periods are less than a year. Short-term receivables, may they be interest-bearing or not, shall automatically be recognized at face amount. As in the case of short-term non-interest-bearing receivables, the effect of discounting is deemed immaterial, hence it is not necessary. The third one, the 14% 3-year note from Charlie Corporation worth 20,000, will also be recognized at face amount since it is interest-bearing. Discounting it is not necessary as well. Its stated interest rate, which is 14%, will be used in determining the interest income, and the market interest rate of 10% as of the said date will be ignored. The corresponding entry would be debit notes receivable Alpha Company 5,000, notes receivable Beta Incorporated 10,000, notes receivable Charlie Company 20,000, and credit sales worth 35,000. Our second case is on long-term receivable with reasonable stated interest. On January 1, 2016, Pretzi Corporation sold goods worth 100,000 to Alodia Corporation for 500,000 selling price. Pretzi received a 10% promissory note from Alodia. Said note indicates that the 500,000 selling price shall be payable in 5 equal annual installments with interest each year. The market rate of interest is 15%. Assume that stated interest is reasonable. The company uses perpetual inventory system in accounting for inventory. The requirements are: prepare the necessary journal entries for the 5-year period, prepare the amortization schedule for a supporting computation. Since the note receivable is interest-bearing, discounting is not necessary. The stated interest rate of 10% will be used in determining the interest income, and the market interest rate of 15% will be ignored. The note will be initially recognized at face amount, which is 500,000.
First, let us complete the amortization schedule. It shall be composed of 5 columns with the following headings: date, cash received, interest income, amortization, and carrying amount. As observed, the amortization at the end of each year is 100,000. This was computed by dividing 500,000 by 5, since it was stipulated that the note is payable in 5 equal annual installments. On January 1, 2016, the note's carrying amount was 500,000. The carrying amount at the end of each year can be computed by deducting the amortization to be paid in that certain year from the carrying amount at the end of the previous year. As in the end of 2016, the carrying amount of 400,000 was computed by subtracting 100,000 from 500,000. Meanwhile, the interest income at the end of each year can be computed by multiplying the carrying amount at the end of the prior year by the stated interest rate. As in the end of 2016, the interest income was computed by multiplying 500,000 by 10%. Each item under the cash received column can be computed by adding the interest income at the end of a certain year and the amortization at the end of the same year. As in 2016, 150,000 was computed by adding 100,000 and 50,000. Let us proceed to the journal entries. On January 1, 2016, the entry to initially recognize the note would be debit note receivable 500,000, credit sales 500,000, and also debit cost of goods sold 100,000 and credit merchandise inventory 100,000. Subsequent entries can be based from the amortization schedule. For example, on December 31, 2016, cash is debited for 150,000 and notes receivable and interest income are both credited for 100,000 and 50,000 respectively.
The next case will be on non-interest-bearing note payable in one period. On January 1, 2016, Pretzi Corporation sold goods worth 100,000 to Alodia Corporation for a 500,000 selling price. Pretzi received a non-interest-bearing promissory note from Alodia. Said note indicates that the 500,000 selling price shall be payable at the end of 5 years. The market rate of interest is 15%. The requirements are: prepare the necessary journal entries for the 5-year period, prepare the amortization schedule as supporting computation.
First, let us analyze the note receivable. It is non-interest bearing and it is to be paid in lump sum. Therefore, it needs to be discounted using the effective interest rate method, and the present value of one factor must be determined. The market rate of 15% is to be used. Substituting the values into the formula, PV of 1 will be sold to 0.4972, and multiplying it to 500,000, the carrying amount of the note at initial recognition in the amount of 248,588 will be computed. The amortization schedule shall be composed of 4 columns with the following heading: date, interest income, unearned interest, and carrying amount. The interest income at the end of each year can be computed by multiplying the carrying amount at the end of each previous year by the market rate. For example, in 2016, 15% of 288,876 equals to 37,288. Since cash can only be received at the end of 5 years, no cash payments were received in 2016, 2017, 2018, and 2019. Therefore, the cash received column is only filled in 2020. This also means that there is no amortization during the first 4 years. Therefore, the respective interest income per year shall be added back to the note's carrying amount until the same becomes 500,000 as in 2020. Let's proceed to the entries. On January 1, 2016, the entry to initially recognize the note would be debit notes receivable of 500,000, credit sales of 248,588, and unearned interest income of 251,412. And also, under the same date, you will debit cost of goods sold for 100,000 and credit merchandise inventory for 100,000. As noticed, the amount credited to sales is 248,588, the carrying amount of the note computed using the effective interest rate method. 251,412, which is the difference between the note's face amount and the carrying amount, is recognized as unearned interest income. The subsequent entries can be based from the amortization schedule. For example, on December 31, 2016, the entry was made to recognize the unearned interest income earned for the year. On December 31, 2020, the entry was made to recognize the lump sum payment.
So that's all for notes receivables.
Thank you for watching.
If you liked our tutorial, give us a thumbs up.
Leave a comment below, and don't forget to subscribe.